How do you know which stocks to buy? So you've heard me say that we need to invest our money so that it can grow. You know that means buying businesses, right? But you look around and you see that there are thousands of companies just here in the United States alone. How do you know which one to buy? How do you even get started? Well, it's actually a lot simpler than you think, but I'm going to walk you through the logic step by step first. So to start, imagine that you're looking to buy a business and you start by looking around your hometown. You look at the diner down the street from you. It's making tons of money and it's for sale. Do you want to buy it? Sure, but you can't afford to buy it all on your own. So you get 10 of your friends together and you each pitch in 10% of the purchase price. You all buy it together. That's what being a shareholder is. In other words, that's what happens when you buy a stock. It's owning a fraction of a business rather than buying it all on your own. You then own a little piece of the profits from that business, as well as a little piece of anything that the business owns, like the building it's in or the industrial kitchen equipment. You're just a silent part owner of the business. When you buy stock, always remember that it's not just numbers on a screen. You're going in with millions of your friends and you're buying a company together. Okay, great. So back to the diner. You and your friends can go in together and buy that diner. But what if the diner goes out of business or falls on hard times? Maybe you should also own a different business too and split your money between the two. So you put half of your money into the diner and half of it into maybe the Mexican restaurant down the street. Now you own two different restaurants. So if one doesn't do well, maybe the other one will. So now you're a little bit more diversified. Diversification is when you don't put all of your eggs into one basket. It helps protect you from company-specific risk. In this case, what if the manager of the diner does a really terrible job and customers stop coming? Well, that manager created a problem that is specific to that diner, but the overall restaurant industry might be good, as in people in the city still want to go out to eat. So buying the Mexican restaurant too means that you can still benefit from the overall market of people wanting to go out to eat, even if one specific restaurant doesn't do well. But what if people stop going out to eat? Maybe there's a recession and people have less money to spend, so they all start cooking at home instead. Restaurant sales drop. Well, you own two restaurants. So even though you're more diversified than just owning one company, you're still very concentrated in one industry, the restaurant industry. So big trends like that could still really hurt you. So maybe instead of just owning the two restaurants, you might also want to buy shares in, say, the local car repair shop or an electronics store as well. Those different kinds of businesses will probably perform differently in different kinds of economies. Even if people stop going out to eat as often, they might still need to replace the brakes on their car or get a new phone if they drop theirs and break the screen. So now you have a little bit of protection against company-specific risk and against industry-specific risk. But you're still invested all in one town. What if something happens to the town and a bunch of people lose their jobs and move away? Now all the businesses in town are going to do badly. So maybe instead of buying all the businesses just in your town, maybe you want to buy some businesses in the next town over or across the country or even internationally in different countries. This adds geographical diversification. So if something bad happens in one part of the world, it'll only affect some of your businesses, not all of them. Now you're protected against company-specific risks, industry-specific risks, and location-specific risks. But there's also another kind of risk, which is the risk of missing out. Let's go back to your diner. What if the actual best investment was a sushi restaurant? Maybe it didn't look great when you were looking at restaurants because it had been struggling, but actually now it has a new chef and it's about to do really well. And because you bought the diner instead, maybe you get returns that are just fine when you could have had incredible returns by buying that distressed sushi restaurant. That's the risk of missing out. How do you know in advance what companies will do well? Because it's not as simple as good business, bad business. It's about growth potential and how much it costs to buy them and a bunch of future trends and changes in macroeconomics that are unknowable in advance. There are a bunch of companies out there. Some of them will make good money. Some of them might lose money. Some of them might go completely bankrupt and you lose everything that you put into them. But a very, very small percentage of businesses will explode and become the next huge thing. The problem is you don't know in advance which companies will do this. I mean, who expected a little online bookstore to become the future of commerce like we have today with Amazon? So it's very hard to pick specific companies and not miss out. If there's some new technology being developed and there are a bunch of companies working on it, how will you know in advance which one will actually be the winner 10 years from now? If you try to pick individual companies, it's very possible that you're going to choose wrong and buy the losers that will try and fail and go to zero. And it's very likely that you'll actually overlook the one or two companies that will actually grow to be winners. How do you know which companies to buy when you can't know the winners in advance? Maybe you think you can pay some finance professional to pick the winners for you. You could try to buy actively managed mutual funds or pay a financial advisor to be your personal stock picker. They might have more training in financial analysis than you, and they might have more time to pay attention to market news. But the academic research shows that it doesn't really matter. All stock picking involves making some predictions about the future. And the studies show that even most professional stock pickers can't consistently beat the market. And as a whole, they end up underperforming essentially by the amount of the fees that they charge. Those few that do outperform, you always have to wonder, did they just make some lucky calls? Picking a good fund manager becomes just as difficult as picking a winning stock. You can't predict the future. And no one else can either. So maybe don't pay somebody high fees just to try. So what do you do? How do you ensure that you're going to own the winners before they blow up and get really big? How do you have the winners if you can't pick the winners? Well, the trick is you don't actually have to know who the winners will be. You just buy all of the companies. That way, you're sure to own the winners. Now, it's true that means you'll also own all the companies that will fail and go bankrupt too. But the most that they can lose is 100% of their value. The companies that do really well won't just gain 100% of their value. They might 10x their value or 100x their value or more. There's no ceiling to how much they might grow. So by owning everything, the losers will fall away and the winners will grow. And you'll benefit from that upward bias as all the companies that you own try to grow and invent new products and expand into new markets. That's how total stock market index funds work. These are funds where you pool your money with other investors, and then the fund managers buy a little bit of every publicly traded company in the United States market. And they have international versions too. Your money isn't divided evenly between all the companies. A little bit more of your money goes to the bigger companies and a little bit less goes to the smaller companies. This way, the actual portfolio looks and behaves exactly like the market itself behaves. When a huge company does really well, it has a bigger impact on the market and the economy than when a tiny company does. So your index fund will behave the same way. So this is why we diversify. Because that diversification helps eliminate different risks. Those company-specific risks, the industry-specific risks, location-specific risks, so that all that is left over is market risk. There's still risk to investing, meaning that your portfolio is still going to fluctuate up and down. That's called volatility. There's going to be bad news sometimes that causes the whole market to drop, or bad economic conditions that cause people to spend less money. And that will cause businesses to do less well for a while. This is normal. But if you can understand why owning the diner down the street might help you financially, where you'll get to keep a little bit of the profit the company makes after it does a good job and serves a bunch of hungry people, then you can understand why owning thousands of companies all at the same time will also be a good thing. All of those businesses are also out there trying to serve their customers well and make a profit. A total stock market index fund just means that you're able to buy thousands of companies all at once. That means it's well diversified and you're guaranteed to hold the winners. That's why I think index funds are the best way for most people to invest. And the good news for us is that means that investing itself is actually really simple and easy. You just set up recurring purchases of a total stock market index fund to own all of the United States companies that are publicly traded. And then you probably want to add a total international stock index fund to own all the companies outside of the United States. And we'll talk later about adding bonds if you want to lower the volatility of your portfolio and smooth out the ride. But it should be a relief to all of us that to achieve our financial goals, we don't need to analyze companies and economic data and try to pick individual stocks. We don't have to overcomplicate it. We can just buy a few funds in just a few minutes. We can set it up to happen automatically. We can set up recurring purchases. And we can all go on with our lives and spend our time on what really matters instead. In the next video, we'll talk about why we don't need to try to time the market too. And we'll have videos in the future about selecting the right index fund and how to buy it in your account. So what do you think? Did I make a good case for diversification and buying index funds? Or do you still want to try to pick individual stocks? Let me know in the comments. But in the meantime, if you have any questions, send me an email. I'm always happy to hear from you. And your questions are really helpful in finding topics for future videos. So I appreciate when you do that. I hope, like me, that this video gives you kind of a sense of relief that it doesn't have to be super complicated. You don't have to go all in on being a finance bro and researching individual stocks and following all the trends. It can be really simple. Oh, one question for you. Let me know if you want me to get really nerdy about the studies about actively managed funds versus passive benchmarks and how hard it is to pick fund managers that outperform. I said there have been a lot of studies about it. I don't want to just say, trust me, bro, but if you want me to get nerdy, I will. But also, Ben Felix is out there for that. So anyway, thanks for listening in. Why did I just do finger guns? Night recording's dangerous. Okay. Hope you enjoyed. Hope you have a great day.